Hello and welcome to The Big Fight, and it is Diwali and it's time for our annual special right here on The Big Fight. This is the episode where we get all the top experts in the field to tell you where you should invest your money for the next year. So this Diwali, where should you be putting in your money so that you make the maximum return by the next Diwali? And we're going to be looking at individual asset categories and all of that. I'm not so sure about specific stock tips if that's what you're looking for, but in general, you'll get a sense of what you should be doing with your money. And I'd like to welcome some of those who've been with us in some of the previous episodes as well. Ghulam Zia, great to have you with us. Executive Director, Knight Frank India, is going to tell us whether real estate is something that we should really be buying. And somebody else who's going to be casting an eye on that is Naveen Raheja, who's Chairman Managing Director of Raheja Developers, of course, but also Chairman FICCI Real Estate. So can give us some sense of where that is headed. Equity, is that the right place that you should be putting in your money? Well, we have none other than Abhay Aima joining us, Director, HDFC Securities, one of the best experts that I know of in the field of equity, and will tell us whether this is the year where you're going to see the mother of all bull markets and the Sensex at 70,000 by next Diwali. Well, okay, maybe I'm exaggerating a bit. Even 35,000 is not bad. Oh, 30,000 is not bad, come to think of it. All right, so Abhay, great having you with us. And then if you're thinking about equity, well, you should really be probably, if you're a retail investor, be putting it into mutual funds. And I can tell you, there is nobody in this country who knows mutual funds better than Dhirendra Kumar, CEO of Value Research. And if you're putting your money into mutual funds without consulting his research, then let me give you a recommendation. You shouldn't be doing that. Do check out his recommendations and his star categories, and that's really, I know, where you should be putting your money in. So Dhirendra, you're going to be telling us which mutual funds presumably people should be looking at, and equity mutual funds or debt mutual funds or bit of both, which are
not from Diwali to Diwali, you know.
Yeah, Diwali to Diwali. It can't keep changing year by year, so who knows. And now somebody who has a completely different point of view who's going to say, why on earth are you wasting your time trying to invest your money?
Diwali
Spend it. It's Diwali. It's time to burn the money. Go out there and buy it, and preferably buy it on our portal. Amit Bagaria, Vice President of Paytm. So spend the money, right?
Absolutely. The right time to spend money, right?
Right time to spend your money. And somebody who may or may not be saying something similar, who may be saying buy designer outfits and designer goods and gold, is Reena Dhaka. So Reena, great to have you with us. And maybe you can put in a word for gold and jewelry as well. Gold actually is not a bad thing to put your money into. This tie actually indicating that, so maybe I'll speak for gold as well. Right, thank you all so much for being with us. Where do we start off? Stocks, let's go with stocks first, I think, before we come to real estate. So Abhay Aima, Diwali to Diwali, this summer, not necessarily the most exciting year that we've seen in the Indian stock market, been reasonably flattish. There are some worries on the horizon, especially on the global front. What would your advice be right now? Go out and buy a bunch of stocks, or don't do that?
India is a country whose idea has come. I think there are so many paradigm shifts that are happening that whether we like it or not, this is a country you cannot ignore. And if that is your view on a country or on a view on a stock, in this case I'm equating the two, then I think the best thing is to go ahead and buy it. Because I think what you have seen up till now, you see much better going ahead, and one can go into discourse and elaborate that why that is going to happen, but not necessarily restrict your view from Diwali to Diwali. It would be much better if you are taking an equity call and you really want to encash on it, to take a 2019 kind of view.
A longer term view, and the reason why that happens, is because over a long period of time, equities almost always outperforms most other categories. Over a short period of time, it can go south. I have to say, when the Sensex is at 27, 28,000 or 29,000, saying that you should go out and buy stocks is slightly more difficult and slightly more challenging than the opportunity which all of us got in January this year or February. If the stock market goes down to 21, 22,000, it's almost a no-brainer. You should be buying stocks. At these levels, are you still comfortable, or there'll be some people who are saying stocks are overpriced?
You're right, Vikram. I don't think they're overpriced, but if there was at 17, 18 or 21,000, it was a no-brainer. I still think the best is yet to come. So what you're going to see over, that's why I said, just don't restrict your view from Diwali to Diwali. So if your view is 2.5 years plus, then I think you still have time to live with which volatility which you might see along the way. But on the whole, I think you will see a very good time as far as stocks are concerned. I think 2.5 years back, you'll get abnormal returns in equity.
Abnormal returns in equity over the next 2 to 2.5 years. Dare I ask you to stick your neck out and make a prediction? Sensex, the day of the elections or like 1 month before the elections, 2019.
If you take the Nifty, on an annualized basis, you'll see 40 to 45% return from here over the 2.5 year period.
40 to 45% annualized return. Wow, you've almost sold me on that.
No, not
let's end the rest.
annualized. Sorry, I said not annualized.
Okay, 40 to 45% return on the
you're
Nifty.
talking about annualized about 20%, yeah.
Okay, 40-45%. All right, that's it. You've almost convinced me. All of you can go. We are done. The rest
We
of
should
the show
run.
the rest of the show is irrelevant. Don't spend your money. Okay, but let me get some more views, and I'm going to all of you to come in and see whether you agree with him or disagree with him. Virender, do you agree with a broad view that equity is right now, given what's happening with the India story, something to be putting your money into?
Yeah, I agree. Broadly agree with him about the India story. I agree with him that this could be we could be in for a long-term bull run. Triggered by very structured, organized or very unusual thing happening in our economy or in the business framework. I don't agree with him about of course I'm nobody to agree, but I really don't. I think it's very difficult to guess that 2.5 years, 45%, 40%. I agree, and I would like
to be fair to him, I twisted his arm and I got him to say something.
Yeah,
so
I don't know, but I think that I have a slightly different viewpoint, which you might find more compelling. That if somebody is not going to be investing in equity in the coming decade in a methodical way, he'll be poor. He will end up being poor, despite having earned money, simply because the rate at which the fixed income rate is declining, the PPF rate, the Indians are fixed income investors. They put money in deposits, they put money in the PPF, and the way it is crumbling, you will earn a lot, you will save, you will put that money, and you will not be able to have enough to you will outlive your savings. You will end up dying very poor, and that to eliminate that possibility. And this is not a Diwali to Diwali theory. This is something which you have to really think in terms that how you are going to end up with, and that is what you save for. Saving is postponed consumption. When you don't use Paytm, you are basically taking care of something at a future point of at a future date. So I think
to be fair, that probably applies to any of the platforms.
Yeah, also I think that
don't blow up the money. Don't.
And be
postpone
methodical
that
about
party.
it.
Certainly don't burst crackers in any
and
case.
Saving will not be enough. Just saving money will not be enough. Even just putting it money, parking it, being methodical
and
about it.
And that's another reason for that, Virender, which is I think important to say is that because inflation is high in India, and this is something that a lot of people don't factor in. They say, yeah, if I'm saving it and I'm putting it away in debt funds or whatever, I'm getting 7%, it'll grow to this much. Yes. But the value of that money will depreciate. You may be very happy and think, oh, I'll have 50 lakh rupees when I'm 60. But when you're 60, 50 lakh rupees for all of these people who are kids,
I would like to
bring in not be able to buy them a burger.
I would like to bring in this. Yeah, definitely.
Don't be that surprised. Given what inflation is, when you're 60, 50 lakh rupees, you'd be surprised at how little it could be buying you.
Yeah, we actually think only in terms of that the compounding will make your money this much.
Yeah.
We don't really compound our expenses, and the inflation number that you see, which is put out by the government, is not going to be your inflation number. Your old age healthcare cost will be completely different. It is not growing at 5%. It is not going at 7%. Your cost of education.
I'm going to get Dhirendra in a couple of minutes to start talking about the 3 magic alphabets, the particular acronym that he's going to talk about, which is going to transform all of your life, and eventually you will listen to those 3 initials that he's going to give you, and you're going to eventually be rich and not poor, and I'm going to come to them in just a couple of minutes.
Well, I need to be in their side then to get a class on this one.
But before he comes to those 3 letters, why do you think he's wrong and you should just blow up the money
I think I'll not say it's necessarily wrong, right? Because he mentioned investment is not a Diwali to Diwali phenomena, right? I think individuals now need to be more particular about investing regularly, more regularly. stay in tune with what's happening in the markets. He mentioned about the fact that your expenses will compound, your inflation will also compound. Also the fact that consumption will also increase in the country, right? In the future, there will be more access to newer products, to newer technology, which would mean that people need to save much more for the future, right?
And
but for Diwali,
and your app. So now every time somebody says, I want to save some money, on the other hand, they are seeing Amazon or Flipkart or Snapdeal or Paytm saying, no, deal, buy a phone, buy this, buy this. I mean,
so invest throughout the year, but for Diwali, shop, because Diwali is the season of festivals. I think people need to pamper themselves a little bit. But I think I agree with the
respond to that.
I would say that, spending is, it's very unreasonable to expect that don't spend, invest all that you save. But, be a little methodical about it.
Okay.
Don't be impulsive. Don't be rash. And I think, we should give them the credit that it has become easier to move our money around.
Yeah.
It has made easier to remit our money. It has made possible,
So
and of course, till they are venture funded, we will be getting it cheaper.
Yeah, so yeah, that's true.
So that's fine.
So if you can afford an 8,000 rupee phone, maybe you should buy an 8,000 rupee phone and not say I'm going to buy a 20,000 rupee phone. Buy that 8,000 rupee phone, or Dhirendra would say, buy a 7,000 rupee phone and invest the 1,000.
No, I would like that, they buy something for 9,000 rupee, give it to us for 6,000 rupee, good till it lasts.
That's why I'm giving it to
what we'll do as a platform.
Before I come to them and before I get you to give those three magic alphabets, equity, before I come to real estate, your take on what he's saying, that eventually get into equity, and that's what Abhay was saying also?
Well, I would go for equity.
Over real estate?
Over real estate for sure. And if I am a bit, risk averse, then I would go for those three words those are coming.
Yeah.
But then perhaps the real estate will be third or fourth preference for me.
Okay, but you would pick equity over real estate?
Indeed.
That's interesting, because Indians are normally real estate buyers. Are you going to stand out for real estate, or are you going to agree with everyone that equity is the best?
Real estate.
You would still say real estate?
I'll be very, very straight. Anything which I invested, real estate is not, you cannot take it investment for 1 year or 2 years or 3 years. Here if you start counting investing today and taking out tomorrow, that is not an investment in real estate. That is a speculation in real estate. And speculation can go wrong anytime, anywhere.
You shouldn't be speculating in real estate. You shouldn't be speculating in equity either. I'm sure all of these people will say that to you.
So, if I go back 30 years, if I rewind myself, all my investments have multiplied by about 1,000 times when it goes to me. 1,000, that means the plot of land 30 years ago for which I invested at 100 rupees a square yard, today I was able to sell it, some of them, for 1 lakh to 3 lakh rupees a square yard. But when I purchased, I made a very, very conscious and strategic decision about how the area is going to develop.
Right. Just to play devil's advocate out here, that same argument could be used for equity, because the Sensex was once at 100. Today the Sensex is at 28,000. So it has gone up 3,000 times, right? If you really figure it that way. And that's the Sensex as a whole. Individual stocks, if you'd been lucky enough to buy, I don't know, Infosys or something like that, you'd have made even more returns than that.
Every investment requires a very rational analysis.
Yeah.
Every stock will not go up. So likewise, every investment in real estate also will not go up.
Okay.
30 years ago, anybody investing and hanging on to that kind of value would make a. What about if you invest now?
Let me tell.
400 years ago, you could have bought Manhattan for the price of a handful of beans.
I seek exemption for last 5 years when the real estate was not real estate; it was a speculation.
Okay.
Only speculation.
Don't speculate.
If you go back, I will talk to all my viewers. Just look at it. If anybody is rich in India today, if you look at everybody, he is rich because of his investment in real estate, not any other investment.
Okay, can I ask you, because I mean, you're after all an expert in real estate, but you would still pick equity. So how do you rebut what he's saying? What he's saying is not entirely wrong. A lot of people have in India made a lot of money on real estate, more than perhaps they have in equity. It's also because they handle equity wrong. And I think it has to be said, a lot of people are very smart about real estate. They buy real estate and they sit on it for 20 years. If they were to do that with equity, they'd probably make a lot of money in equity also. But typically what Indians tend to do is when there's a big bull market and the Sensex will go to 35,000, everyone will be buying equity. And when the market will crash, they'll all be saying, becho equity, which they wouldn't do with real estate. And that's the reason people don't make money. So it's not that equity by itself is bad, but Indians quite often are handling equity wrong.
Entirely, I'm fully agreeing with you in what you're saying. The big issue between real estate and stocks is that in real estate, you can't not get emotions into it. Yeah. And that's what Indian culture is all about.
You cannot get emotions into it, and that brings us to those three magical alphabets.
So, the house, which may not be worth anything, you will still stick on to it because it's your house, because it's your father's house or it's your grandfather's house. That's not the case with equity. If it's making money, you will sell today. I fully agree with Mr. Raheja. If it was completely lacking emotions, you will still make perhaps good money. But if you have emotions coming into it, you will make a big disaster of that.
Okay, so Abhay, Aima, let me get you in on this. The basic point that Mr. Raheja makes, which is that a lot more Indians have made money on real estate than they have in equity. What would you say is the reason for that? Because actually in growth terms, equity is probably still outperformed real estate. But as we were just saying, maybe people don't know how to handle equity properly. There are emotions in it.
Indians per se, I would say up till now, have been risk averse and like to go into. So your ideal investments would be gold or real estate, which is more like a debt instrument. I think that has changed. The concept of how equity is looked at will be changed. Your risk appetite of people within India is going to drastically change. What I was talking about, the paradigm shift that is happening within the country or a country. Now, when all those things happen, so historically, what you're saying is right. Since gold and real estate have been the favorite, I think that mindset is changing, will change, and you will see not only more than normal returns in equity, but you will see more and more people benefiting. And like we were saying, I think Dhirendra is going to talk to, as he'll explain those three magic words. That is one of the way of being not emotionally attached and getting into a long-term asset. So equities need to be looked at as an asset class, not as something you get in and get out of.
So it's not a game. Stock market should not be game. Okay, how many of you want to hear those three magic words? Anybody can guess them?
But I would, before that, I would like to...
The first one starts with an S, and the second one starts with an I, and the third one starts with a P, right? Dhirendra, am I right?
More importantly, what he was telling, I would just like to, bring in a point of view, is that, yes, he's absolutely right. A lot of people are wealthy because they have their homes. It was not their real estate investment. That apart, there are 3-4 reasons why one should not be looking at home as an investment. Of course, it is net worth. It has its worth. One is that, the ticket size. The amount of money needed to have your home. I'm not saying you should not have it, but it's not an investment. It's your home you're going to live in, nothing like it. You can't diversify. It's a leveraged one. A lot of people can't really, would not have saved any money, but just built a home in their lifetime. That's why they're feeling, but they can't liquidate it.
And they have a home, but they're running to live off. When they're 60 and 70, they're saying, where do we pay for our groceries?
And today we see that they are able to liquefy it, they are able to dilute it, they are able to, it has its worth, but it's eventually a home. So look at it very differently. It is not something which is liquefiable in a manner. And then history doesn't necessarily repeat in the same way. More so, it is a very dicey thing to do right now. Going by the statistics,
okay, I'm going to come back to him and say why is it dicey or is it not dicey. But okay, let's just end the suspense. I am assuming that SIP are the three initials that you're looking at. Why is that the magic formula?
One is that
maybe you can explain what it is.
Yes, the systematic investment plan. You have a recurring deposit. We get our salary. Most of the time, what he's saying is absolutely right. In last 20-25 years, stock market has grown substantially. A lot of companies have done very well. In fact, some of the best equity fund would have beaten the best of real estate investment possible. But people haven't experienced it. People's individual investors' experience is very disappointing because people get up in one fine morning. They got up once in 1992. They invested 6,000 crore in master gain. Followed it up 1 year later in Morgan Stanley. They started investing in technology fund once again in 1998. They invested in 2000. As recently as
Always
2008.
emotional, impulsive decisions, probably made at the wrong time.
They are not methodical about it. And before that, what's important to understand that why equity delivers. Equity is ownership. Equity is ownership, and equity is risky, because if you own a company, it can go down in value, it can disappear, it can go bankrupt. So you need to do something to protect yourself, because equity is the only thing which will give you, real linked, returns linked to real state of affairs of the economy. Because cost of car goes up, they have to make more money, and companies always make more money for themselves only because only when their cost of fixed income should be lower. So from that standpoint, equity will always deliver, but it has its risk. So you need to diversify.